All right, let's go ahead and get started. Might have some stragglers coming in, but thanks for everyone to everyone for joining us today on our mid-year. It's hard to believe we're already in towards the middle of August, but our mid-year market review and outlook, August 10th, 2026. So we'll be taking a look back at the second quarter, first half of the year, second quarter, and then a little look forward. Again, appreciate your time. And we'll keep this right to about 30 minutes or so, getting started on time, so we shouldn't have any issues with that. We're going to give you all of our contact information just in case you don't have it. I'm Brian Reese, and on the call with me, you'll see everyone here in a few minutes, but I've got with me Scott Jones and Ryan Ironman. And if you've been on these before, we're gonna follow a very similar um, agenda as what you've seen in the past, just with the most up-to-date information in here. So with that being said, we're part of CKE Financial Services, Raymond James in Crocker Park. Um, we manage retirement plans and we manage individuals' wealth. The three of us are all CFPs, certified financial planners. The rest of our team is in the picture here. You guys should anyone that's a client knows that we added DeCarla Reed earlier this year, so she's with us as well. All of our contact info is on the screen. If you have questions that we don't get to, whether it's related to what we're talking about or otherwise, um, make sure you just email one of us or call us. We're happy to help out. 30 minutes goes by pretty quick, so we don't usually get to too many questions within here. So there's all of our contact info. A little review on what we do for clients. So I know on these calls, or we know on these calls, we have clients who are clients of ours, not clients, and people related to the 401k plans. So this is a one-page summary of what we do, both for individuals and within our 401k plans, but employee one-on-one meetings, group meetings. We do a lot more than we used to through Zoom. So whether that's company related or individual related, but Zoom meetings, phone meetings, in-person meetings. In person is the best, but we still work with clients whatever way is best for them. And then from a financial planning standpoint, we've got ongoing support for that in the planning process as certified financial planners. That's the core of what we do is the planning of it. We do these on a quarterly basis. We're going to start kind of get back to doing in addition to these, some other topical presentations. Again, Zoom and or in person. We'll push that out to everyone once we've got some dates firmed up surrounding that. And then the weekly emails that go out. Ryan's name was on those. I think they're coming from our team now, but just topical weekly emails to everyone. So keep an eye on those. They shouldn't be landing in spam folders, but sometimes they do. So if you're not getting it yet, Friday afternoons, make sure you check that folder or that file. All right, so the agenda for the day, market update. That's me. Key themes. Ryan takes over on the stock market outlook. Scotty will finish with the bond market outlook. Reminder on diversification, available resources. The good news is, before we jump into it, things look great. I mean, the market's doing well still. Stock market, bond market. Um, we're moving along nicely. The look back on the quarter, go over the year to date and the quarter, but the quarterly numbers are right here in the middle. So as we look back at the second quarter, the Dow was up close to 13%. The S&P was up close to 15%. NASDAQ up 21, and the international index was up 11%. So strong returns. We had in the first quarter, remember we had the month of March was a down month, so the first quarter was drugged down by that, but second quarter was a great rebound for us. Corporate earnings continue to do really well. The Raymond James outlook is for corporate earnings to continue to do well, not just the rest of this year, but into next year as well. If we finish this year out with double-digit earnings, like we did in the first quarter and we're doing in the second quarter, expectation is to continue. If we pull that off, it'll be 14 straight quarters of double-digit earnings growth. So just phenomenal. And remember, earnings are the lifeblood of the stock market. So there's other things that come into play, geopolitical, inflation, the war in the Middle East, but earnings are the lifeblood of the market. And if earnings are going well, that usually means the stock market is doing well. So we're really happy about that and the way things are going. So the 12-month return, looking back a little bit further on the S&P, if we just pick one, has been 20%, international index at 30%. Scott will talk about the performance of the bond market, but that's really pulling itself together as well for us. What we've seen since the last quarter with yields. So the 2-year Treasury has bumped up from 379 to 415. The 10-year, little over 4% to 4.4. So again, a little bump up in that. Same with the 30-year mortgage, just a slight increase there. The start of the year, the Raymond James outlook was probably one interest rate reduction. And now the expectation, not just by Raymond James, but by a lot of people, is probably an interest rate increase. So we'll see later in the year is the expectation on that. So we'll see where that goes, but that's the expectation. And think back how gold was doing. We had a record-setting gold run, and second quarter though gold pulled back by 13%. Because the months prior to that were so good, the 12-month is still up 22%, but a downturn in gold in the second quarter. And then crude oil, second quarter, we've seen oil all over the place. Remember, early in the year, especially, we saw the marks when the oil price was down, stock market was up, and vice versa, going in lockstep. So way down in the second quarter. $68, so down 31%. But again, because it was so far up prior to the quarter, the 12-month return is still at 6.74. So overall, though, earnings have been strong. The market has been resilient, regardless of the geopolitical situation, the war in the Middle East, the volatility in the oil prices. Inflation is still an issue. The Fed's got the target rate set at 2%. We're not there. Probably don't move too close to that anytime soon, or at least until the war is over and the Strait of Hormuz opens up and goods are flowing and oil's flowing through to and through there. And then inflation should fix itself once all of those things start happening. Consumer spending is still strong. That's helpful in our economy that's so consumer driven, and CapEx spending is still. I mean, the largest 10 companies are just pumping billions into the AI space still, and they're still helping to drive the returns of the overall market. So all good things there. The two potential headwinds though with the war and inflation, but once one gets solved, the other one probably gets solved. Or moving in the right direction as well. So again, feel real good about that. Keep the earnings coming, and we should be in pretty good shape. And then I'm going to turn it over to Rye to talk a little AI for us and the energy-related stocks.
All right, thanks, Brian.
Yep.
So this chart here is really showing just how much of the market is being driven by earnings in energy and the AI space. If you look at the chart on the left, the orange is the 2025 earnings, and the yellow is 2026 year to date so far. So if you take a look at the AI space, we've seen 41% year over year earnings increase since the start of 2026. And then Energy is up 68% since the beginning of the year. And versus if you look at the S&P 500, the market as a whole, the earnings are up only 22%. So it really shows how much the earnings are being driven by just those two sectors. And then over on the right, this is performance, and we're looking at median year-to-date performance across these sectors. So as you can see, AI, the median stock performance so far year to date is 20%. And then energy, the median stock performance in the energy space is 30%. Uh, Compared to the S&P 500, where the median in those 500 companies is just sitting at 11. So moving on, this chart looks at midterm election years, and specifically it gets at just how strong the market usually performs following a market pullback during a midterm year. So the bar chart on the left shows the average market drop during a midterm election year. So you can see that orange bar there in the negative is that the average uh, is negative 16.3% drop during a midterm year. And then the yellow bar is the following 12 months. The average is 32.9% recovery. Um, so typically we see really good performance um, after a drawdown during a midterm year, which the chart on the right kind of gets at. Uh, the row highlighted in yellow there is this year to date. So we saw a drawdown of negative 9% back in March when the Iran conflict got started. And so far, since then, we've seen a 11% turnaround. Um, and so we're anticipating that trend to continue, um, and we'll see even more growth throughout the rest of the year. If you look at back through the years, the midterm years, you can see that uh, only one of these recoveries was in the negative, and most of them are, double-digit recoveries. So, and then looking at the history of the S&P, once again, the year to date is all the way over on the right. So this is up to date as of the end of second quarter. So you can see that red dot, we had a drawdown of 9%, like I mentioned on the previous slide. And so far year to date, we're up 14%. So again, this chart is mainly getting at long-term investing, taking a long-term approach, and avoiding selling when the market drops. Um, just remember the gray bars across the top are where the market finished for the year. So 75% of the time, the market finishes positive. And then the red dots below are the market low point for the year. So despite every year there being a pretty major sell-off, the market tends to finish positive. Um, and so yeah, just a really good testament to keeping a long-term focus and trying to avoid selling during the downturns. And then our Raymond James year-end targets for the S&P 500. Uh, every year, Raymond James economists come out with a equity target for the S&P 500 for year end. Our original target was 7,250, and we gave that a 60% probability based on what we were seeing at the beginning of 2026. And then over on the right is our newly updated target. So now we're predicting the S&P to be at 7650 by year end. Um, we've already, seen the market surpass that. Um, and we decided to up the estimate due to just how strong earnings have been and as well as the labor market. Um, and we're actually tending more towards the bull case these days, which we could see it going as high as 8,200. Um, and then with that being said, I'm going to pass it off to Scott to talk about the bond market.
Awesome. Thanks, Ryan. Yeah, I mean, there's no question that we've had, secular trends. We talked about the AI and the energy, and we're coming on 4 years here of positive market performance. So I think, as I close, I'll kind of talk about the bond market and some diversification. But what we're looking at here is just you continue to hear about record cash on the sidelines. This was actually through May 31st, and you just heard about $8 trillion now currently in money market funds. So pretty significant increase over the last few years. There's some reasons for that. Some of it has to do with the increase in interest rates in 2022. Fed funds rate, went from 0.25% over to 5% in a very short time period. Had a negative impact on bond performance in 2022. I think some of the traditional bank deposits, checking and savings, some of the interest there was slow to keep up. And so you had, a very big inflow in money market funds from some of that was coming from traditional deposit accounts, checking and savings and things like that. So, but you can see that bond fund inflows have finally surpassed money market inflows, 808 billion to 547 billion in the last 12 months. It's the widest gap since 2023. And so, we're starting to see a shift maybe that the bond yields are reflecting higher rates. And you can see that on the right side of this chart, 3 to 4% money market returns feel very good. There's no question about that. Can understand why people are parking funds there. But if you look at the last year, 91% of all bond mutual funds and ETFs have outperformed cash. Something like almost 1,700 of 1,800 funds, over the last year would have outperformed the money market. So, in over a 3-year period, you even have ultra short and short bond returns, 5.3%, 5.9, 7%. So it may be a time to consider that, especially as you look for longer term, cash needs. We're starting to see a conversation around that. I think for a while there, investors were looking at bond returns of, almost 0% over 5 years, thinking, well, geez, why would I do that when I can just take a safe money market fund and get 3 to 4%? But we'll see where rates go. I know there's been some discussion around that, them creeping up recently, but I think the longer term projection, continues to be that those would go. Ryan, I don't know if you can change the next slide. There you go. Yeah, so you can see here, this is the Fed funds rate historically and where the market expects those to be in the future. You can see the long-term projection is for the Fed funds rate to come down, but in the brief short run here, you do see in green where the market expects that maybe we would get a rate increase of 0.25%, 0.5% maybe within the next 6 to 12 months. So that is something to keep an eye on. But long term, as we expect the Fed long run projection to be around 3%, we would expect those rates to come down, and that would naturally probably run over to some of your money market funds. And so think about that as an opportunity. moving forward. All right, so just kind of want to talk about the importance of diversification a little bit. And we've seen international stocks also perform well in this market environment, and so this chart here just looks at asset class returns over the last 15 years. You can see on the far left over here, large cap, this green box represents the S&P 500 index, and it's been the highest average return per year, fairly significantly, beating small cap at 9.5%, real estate and asset allocation. But if you look over on the far right, this purple box is actually emerging markets. And in 2025, the gray box is your developed international stocks. And so those were the best two performers in 2025, beating the S&P. And so there is a need, to consider that as we move forward. We're in an environment where, small caps are doing well, international is doing well. The large cap index is up 10.2% through June 30th. It's actually a little higher than that to date. But overall, as you move forward, this we talk about with our 401k employees and the participants in plans, making sure that you're in some type of investment strategy that's being rebalanced. Rebalance basically just makes your mix come back to the original selection that you wanted, because in this environment, obviously when stocks are doing well, they tend to grow faster than maybe your cash and bond positions. So you're going to ultimately wake up with a higher weighting to those higher return positions. And so naturally that could mean that your portfolio becomes more aggressive or more riskier than you originally wanted it to be. And so that's why it's important to make sure that you're looking at rebalancing and keeping your portfolio appropriate for the risks that you're willing to take. And so another part of this slide that we like is the white box. This represents asset allocation. We also call that a balanced portfolio. It's basically a 60% stock, 40% bond portfolio. And you can see that it never finishes at the bottom in the worst performing category for the year. It's never at the top either. But it can give you a really nice, reward without taking as much risk as the overall market. And so that's something that we need to be mindful of, particularly as we get closer to our goals, whether that be, 529, sending a kid to college, whether it be retirement, which is a lot of people' main goal, 401k. We need to be mindful of when we need to start taking funds to provide payment for those goals. And we don't want to be taking necessarily large risk when we're about to pay for some type of goal that we've been planning for a long time. So the other thing I wanted to mention along with that is the overall exposure to technology. And so we have a chart in here. I don't know if you can advance it. I'm having trouble advancing. Let's see. Sorry about that, folks. We'll have this up and running here in a second. Looks like we lost Ryan, but Brian and I will finish up here. I'm going to reshare the screen I wanted to show with the diversification. So this chart here is part of our presentation, and we'll record, this call will be recorded. You can refer back to it, and we have the slides available if anybody wants them. But the overall concentration in the global stock market, equity market. So this chart is basically looking at the top 10 stocks in the index. And you have US, which would be the S&P 500. You have the emerging market index. You have Europe, and then you have Japan. And so it's also giving you the weight, the total overall weighting by market cap of what those 10 stocks represent. So the US S&P 500, 38% of that, the weighting of the whole index is basically in 10 stocks. The emerging markets is a little higher, 41%, 5.1 trillion. Europe, 30%, and 30% in Japan. But if you look at the colors, the gray color represents technology. Obviously, it's very important, part of the AI build out, secular trends that are going on. But you can see, especially in the emerging market index, this TSMC stands for Taiwan Semiconductor, got Samsung. These are a lot of microchip manufacturers and things of that nature. So we've been having calls recently regarding, the exposure to technology, something you want to be mindful of. I will say, there was a tech bubble in 2000. Some people will kind of refer back to that, but you have to understand a lot of the leading companies of today and certainly the top 10 stocks of the index are more than just one, they're having record earnings, but their earnings are diversified. They sometimes have different product segments. Amazon, for example, is in multiple different markets, even Whole Foods, for example, MGM Studios. So, there is kind of more diversification amongst our top names in the index, but it's just something that you want to consider to keep your overall diversification focus. So, and how we help participants and clients with that is we do have in 401k plans, we have risk-based portfolios, model portfolios that we'll manage. And then there are also a lot of times what are called target date mutual funds, which can help you diversify simply. And then, obviously, we like to say green is good, but doing it yourself is, obviously can be risky. So reach out to us if you have questions, if you're not sure, if you're diversified, if you're taking too much risk. It's something that I think is a very good time, given where we're at in the cycle and what we've experienced over the last 4 years with good market growth, to be considering at least making sure that you are rebalancing or making sure that you have the appropriate risk for your goals going forward. We also have questionnaires. We have a Raymond James version of this that we use internally. This is our questionnaire that we use for our 401k employee clients. And this is our contact information. We also offer, individual meetings where we have an online scheduling tool where you can pick a date and time that's convenient for you. We're happy to meet with you and your spouse or anybody else that you feel needs to be part of that conversation to help you plan through these things in more detail. So I know we covered a lot. We've talked about a lot of positive things. We continue to believe that there'll be good earnings moving forward. Just know that we've had a lot of good growth over the last several years. So if you haven't checked your portfolio in some time, it'd probably be a good time to revisit. Have some disclosures to read. You can refer back to, and then I did want to kind of encourage you to follow our different pages. I know a lot of you follow us on LinkedIn and some of our social media channels, but the QR code here will take you to our LinkedIn page. You can follow, and we're publishing probably something daily, weekly, and quarterly, Brian, I would suspect, on those pages so that you can keep timely with some of our Raymond James thought pieces and things like that. So we're right at time, 4:30. Appreciate you joining us. We'll look forward to having you join the next call. Feel free to pass this invite along to anybody you feel might be useful. And thanks for being a client or prospective client, and we look forward to working with you. Take care.